Welcome to Factful Finance, where we break down complex financial topics so you can take charge of your money with confidence. Did you know that nearly 60% of Americans are unsure of how stocks work? If you're one of them, you're not alone, but today we're changing that. Let's start with a fundamental question. What exactly are stocks? At their core, stocks represent ownership in a company. When you buy a share of stock, you're purchasing a small slice of that company. But it's more than just having a stake. Stocks give you the opportunity to profit as the company grows, whether through the appreciation in value or dividend payouts. Now, it's important to understand that owning stocks comes with risks. Unlike a savings account where your money is guaranteed, stock prices can fluctuate, sometimes dramatically. So, if you're new to investing, it's essential to grasp both the potential for growth and the possibility of loss. Here's a quick example to illustrate. Let's say you're like Noah, a 28-year-old who's just getting into investing. He buys 10 shares of a tech company at $100 per share, investing $1,000. A year later, the company's stock price rises to $150 per share. Noah's 10 shares are now worth $1,500. He's made $500 without doing anything extra. But on the flip side, if the company's stock drops to $50 per share, Noah's $1,000 investment is now worth only $500. This brings us to one of the key principles in investing: diversification. Imagine if Noah had only invested in one company and it tanked. He'd have lost all his money. But by spreading his investment across multiple sectors, tech, healthcare, and real estate, for example, he reduces the risk of a single investment wiping out his entire portfolio. Diversifying helps balance risk and reward. Let's talk about something else every investor should know: dividends. A dividend is a portion of a company's earnings that is paid out to shareholders. For example, let's say Olivia owns 100 shares of a utility company, and the company declares a $1 per share dividend. Olivia just earned $100, paid out in cash. Dividends can provide a steady income stream, and they're especially attractive for long-term investors. Now, here's where it gets interesting: growth stocks versus value stocks. Growth stocks are shares in companies expected to grow faster than others. Think about tech companies like Apple or Tesla. These companies often don't pay dividends, but investors hope for their stock price to increase rapidly. On the other hand, value stocks are shares of companies that are undervalued, meaning they trade at a lower price than their intrinsic value. Investors like Sarah, who focuses on value stocks, aim to buy low and hold on to these stocks for the long term, hoping the market catches up to their true worth. Of course, stocks aren't the only option in the market. There are also bonds, mutual funds, and ETFs, each with their own level of risk and reward. But today we're focused on stocks, and understanding the basics will help you get started. Now, as we move towards closing, it's important to mention that all of this is for educational purposes only. Listings of products or apps mentioned do not imply endorsement. Always consult a professional for personalized advice. Before we wrap up, let's dive into a quick action step. If you're ready to take the plunge into stocks, start small. Open an account with a reputable brokerage, choose a few companies or ETFs to invest in, and watch your investments grow over time. So what's the first step you'll take toward mastering stocks? Share your thoughts in the comments. We love hearing from you. Thanks so much for tuning in to Factful Finance. If you like what we do, why not subscribe and click the bell so you don't miss out on expert tips to boost your financial knowledge. We think you'll find the next video on screen helpful in reaching your financial goals. See you in the next one.